right now the U.S. is on this very unsustainable fiscal path where they're running very, very large deficits. And historically, the way you deal with that is you kind of monetize it. If you're an emerging market and you owe debt that you can't print, like if you're Argentina and you owe dollars, you just kind of have to default or ask for like a restructuring. Whereas if the liabilities are in your own currency, like if you're America with dollars, if you're Japan with yen, you essentially print the difference, but that leads to inflation. You're inflating away part of the debt. And right now they're kind of in that counter push where they're kind of trying to get the wheels back on the cart. They're kind of trying to say, this is sustainable. We're going to get back to like financial discipline.
Lyn Alden recently shared a Twitter post of the chart that was published by the U.S. Treasury showing the growth of U.S. debt as a percentage of GDP. The chart assumes no changes to the current fiscal situation in the U.S., leading to a ballooning of debt with no end in sight. However, in real life, it is expected to be messier and result in rapid growth in nominal GDP due to monetary inflation. According to Lyn Alden, a seasoned investor and commentator on this topic, austerity historically doesn't work well once you get over 100% debt to GDP. GDP is so reliant on those deficits that cutting deficits hurts the GDP too. So usually a significant currency devaluation component occurs. For that not to happen would be extremely rare at this stage. She further added that there has been a rise in offshore dollar-dominated debt owed by entities in countries such as Turkey, Brazil, and China. The U.S. has a large monetary base to support its assets and liabilities, but these assets and liabilities are highly leveraged compared to the monetary base. This results in liquidity crunches. The U.S. is currently on an unsustainable fiscal path with large deficits. Historically, the way to deal with this is to monetize the debt, but that leads to inflation. If the U.S. returns to financial discipline, it could get the debt under control and buy and own dollars long-term. If not, it is expected to lead to further rounds of quantitative easing and negative real yields, leading to the case to buy sound money, such as Bitcoin. Alden also believes that the Federal Reserve's creation of money through quantitative easing, QE, from March to May 2020 was problematic and had far-reaching effects. She argues that this sudden increase in the money supply changed the entire economic system, making it difficult for the dollar to coordinate trade effectively. This, in turn, impairs the ability to deliver real goods and services and could eventually lead to hyperinflation and a failure of the currency to coordinate trade. Lyn Alden, unfortunately, sees this as a path toward economic chaos. We will now dive deeper into the video and explore Alden's convictions towards the Fed's policies and their consequences on the global market. As you enjoy the video, please do not forget to give us a like, subscribe, and make sure to leave your comments.
That's kind of like no recessions, no wars, no XYZ. That's just kind of like business as usual if nothing's fixed. Of course, it can't actually end up looking like that because you'd run out of base dollars to support that. You'd eventually would have to print the difference, and therefore you'd have a rapid growth in nominal GDP, which would mostly be the inflation component, and it would be a lot messier than that in real life, which is kind of why I kind of picked fun at them for publishing that chart.
Yeah.
I've done actually similar analysis to what Parker just described, which is, kind of looking at ratios of either money supply, like broad money supply to base money, or total debt to base money. And so you can plot them over time. And we did hit a peak back in around the global financial crisis. It was something like 60 to 1. I think his chart showed 52 trillion to less than a trillion. If you kind of do the numbers, it was like 60 or 65 to 1 ratio. And the last time we hit a super high ratio was actually 1929, like the early 1930s, before there was all sorts of like monetization then. And you kind of had this big echo happen ever since the global financial crisis, where we've been increasing the monetary base to try to catch up with that broader setup. And the 13 trillion I mentioned was specifically the offshore dollar-denominated debt. So that's like debt that'd be owed by entities, either governments or corporations in places like Turkey, Brazil, China, countries around the world that use dollars. And the challenging thing here is that both assets and liabilities in many cases are denominated in dollars. So in the United States, for example, we have 100 or 200 trillion dollars in total assets. That includes real estate, stocks, bonds, things like that. Even if you just factor out the debt, you have basically real estate and stocks. That's on a pretty small monetary base. And then you have all those liabilities. And so it's kind of this that's why you get these liquidity crunches when they try to do things like pull dollars out of the system, or if there's any sort of shock to income while all of these, assets and liabilities are highly levered compared to the monetary base, and you see a similar effect when you look globally. And essentially, what we're seeing now with that chart you brought up is just that right now the U.S. is on this very unsustainable fiscal path where they're running very, very large deficits. And historically, the way you deal with that is you kind of monetize it. If you're an emerging market and you owe debt that you can't print, like if you're Argentina and you owe dollars, you just kind of have to default or ask for like a restructuring. Whereas if the liabilities are in your own currency, like if you're America with dollars, if you're Japan with yen, you essentially print the difference, but that leads to inflation. You're inflating away part of the debt. And right now they're kind of in that counter push where they're kind of trying to get the wheels back on the cart. They're kind of trying to say, this is sustainable. We're going to get back to like financial discipline. And it's one of those things. If you do the math and you do somehow conclude that they can do it, if you think, okay, they can return to structurally positive real yields, they can get this under control. They're going to do all sorts of fiscal adjustments to get the debt under control. They're going to start paying it down. Then that's a good case to buy and own dollars long term. On the other hand, if you do the math and you kind of realize that this is almost certainly unsustainable and that almost any attempts that they try to change the system will probably cause a problem elsewhere in the system and continue the kind of the perpetual debt increase and more rounds of quantitative easing and long stretches of negative real yields on all these various bank accounts and debt instruments, then that's a case to buy, like sound money. Historically that could have been gold. Of course, this is a Bitcoin show. Bitcoin is the fastest horse in town, better in many ways compared to gold. And so essentially that's kind of the case to buy those harder monies if you view them as more sound than what you're probably going to get with the U.S. financial system, let alone when you do kind of a similar analysis on other countries around the world and their debt issues.
The creation and distribution of money by the Federal Reserve and government have significant impacts on the economy as it favors certain groups over others and has unequal distribution. During the COVID-19 pandemic, large corporations had an advantage over small businesses as they had access to public capital markets and support from the Fed. The distribution of money can also have a significant impact on the economy as it can lead to imbalances in the economic structure and contribute to future financial crises. As Lyn suggests, people in developing countries often face ongoing currency devaluation issues and need to think about ways to protect their wealth. In this context, it can be difficult to know what to hold one's wealth in, but some possible options are stable currencies like the US dollar or gold or real assets like property. However, each option comes with its risks and benefits, and ultimately, it depends on individual circumstances and personal preferences. What do you think of Alden's view on the Treasury charts? Feel free to drop your opinions in the comment section. Also, make sure to like the video, subscribe, and turn on notifications. Thank you for watching.